Hello guys, welcome to today's session in Concept, and today we will be learning about a very important topic in investment, right? But before that, if you're new to the video, you can go in the description, there is a link below, you can download and install the wealth application of Concept. After successful registration, you will get some tools here that will help you surely in your investment, right? And there are various videos, multiple videos that you can see in your Concept application also. Right now, coming on to today's video, today's session. So if you are an investor, if you are doing investment from a long time, or if you want to start the investment, right, so you must be knowing that right now there are so many fund manager that handles your mutual fund, right? That handles your mutual funds, like which stocks to, in which stock you have to do the investment, right? Now, do you also know, like, for the mutual fund there is also two categories, that is the active mutual fund and passive mutual fund, right? So today we will be discussing about that. Okay, now as you can see here, I have written the active and passive funds, right? Now there is a difference between them. Okay, if we'll talk about the active, so from the word you can analyze, like, these are the fund manager who trades actively, right? That is why it is active. Now if I go for the passive, so these are the fund managers who trades, who invest like in a passive manners, okay, calmly manners you can say. Okay, now let's go ahead. Okay, I'll show you the definition also. Okay, yeah, so here you can see what is an active funds, right? So active funds aim to outperform the market by employing skilled fund manager who actively buy and sell assets, right? Now what do you mean by that? It means, for example, there are two class of people, right? There are two class of people, and for example, this is the one and this is the second class of people, this is the first one, right? Now the first one thinks that he can invest in a stock that can outperform your index. For example, right now if I'll say Nifty, right? Now Nifty, you can see Nifty is giving approximately the TRI. Okay, now the TRI, it means the returns plus dividend. Okay, so the returns plus dividends, overall this is called the TRI. So suppose the Nifty is giving you a TRI of 26% approximately, just suppose. Okay, now there is first class of people who thinks that they can invest in a stock that can give you more than 26% or 27% or 28%, right? So they are searching for it, they want to invest in those kind of stocks. Why they are thinking that, right? Because if you will see in the Nifty, for suppose in Nifty there are 50 stocks, right? 50 stocks. Now you can see in the 50 stocks, only 4 or 5 stocks are the one which are providing 70% of the returns. The rest 26, 27s, they are providing only 20 to 30 returns in Nifty. Okay, so if I'll tell you, for example, this is the Nifty. So suppose there are 50 stocks. So out of this 50 stocks, only 2, 3 or 4 stocks are responsible for the 60-70% of returns. Okay, the others, the remaining ones, they are providing only 20, 25 or 30% of returns in Nifty, right? So it means there are some stocks who are performing very good, they are outperforming Nifty, right? And there are some stocks who are included in Nifty, but their contribution is very low, right? So that is the mindset of the active fund manager, the people who are doing who are interested in actual active funds, right? Because they want to search for those stocks who are working that way, who are providing the 26 or more than that percent, right? So that is why they have, in active funds, they aim to outperform the market. Our market means the index like Nifty or Bank Nifty, right? By employing the skilled fund manager. So the skilled fund manager, they on a continuous basis, they research the market. Okay, they research the global market also. They provide you the fund which is providing, they will provide you a stock, they invest in a stock that is providing you a good returns. Okay, so overall a very deep market research is going on there, right? Now, so the first point is the experienced fund manager is the first point. Okay, after that you can see the active trading. It means they continuously buy and sell stocks in that active mutual fund, right? So you can see they actively buy and sell. Okay, and they are the skilled professionals who research in active mutual funds, right? Now it costs you higher fee. Why? Because they continuously buy and sell. There is so much research going on. Okay, so that is why they charge you higher fees when you are going with the active mutual funds. Okay, so it is also written here, active fund manager charges higher fees for their expertise and active management strategy. So actively they are building some strategies to find those stocks. They are not going for the benchmark hugging for the stocks which are not performing good, but they are still investing in that. Okay, if they feel like that this stock is not performing good, they will remove their investment from that position, from the stock, and they will invest in a stock that is performing good. They will research it, right? Then this is the fourth point, is seeking outperformance. So active funds aims to generate higher returns than the market average by identifying undervalued investment, right? So they will invest in those which stocks are undervalued, but they can provide you good returns in the near future. Okay, so that is the 4 points that you will see in the active funds, right? Now the second thing is, what is passive funds? So as you can see the definition, passive funds, also known as the index funds, aim to track the performance of a specific market index. Now for example, if you think that I have told you about the second class of people, right, who thinks that it will not be beneficial if they will do the research, if they will go just wait a second. So then there is a second class of people who don't want to outperform the market like Nifty and Bank Nifty, but they want to replicate it. Why? Because they think that even if the Nifty or the index is giving you a performance of 26% returns, okay, so they are satisfied with it. Okay, and they don't want to take much risk, right? So that is why they go for the passive funds or the fund manager. Okay, now talking about the passive funds, so passive funds are the second class people. Okay, so what they feel, they don't want to outrun the index, but they want to go with it, right? As it is written here, passive funds, also known as the index funds, aims to track the performance of a specific market index, right? If I'll tell you, if the Nifty is giving you a TRI, if a Nifty is giving you a TRI of 26%, so they feel like they will only trade with the stocks that is included in the index. They don't want to go for the research. Okay, they will just go with the index funds, right? Now they don't want to they don't want to attempt like they want to beat the market. There is no not that type of feeling, right? But they want to replicate its performance, right? Like if the Nifty is giving is 26%, okay, so without taking so much risk, they will just want to go with this. Okay, they also want like 24, 25 or 26% profit here. Okay, so that is the passive funds, right? Now after passive funds, there are also 4 factors that we have seen in active funds also. So first one is the index tracking. So they continuously, the fund manager, they continuously track the Nifty. Like if the Nifty is doing good, is in the bullish direction, so they will invest in them. Okay, if the Nifty is not doing good, okay, so then they will not invest in the stocks of Nifty index, right? So that is how they track the index. Okay, not doing so much research, but just doing replicating it, right? Now then we have the diversification. In passive funds, why we are having diversification? Because you can see in the Nifty there are so many stocks included from various from the various sectors, right? So that is why there is a diversification included. Now the third one is the lower fees. Okay, now lower fees, so actually right now they are not doing any kinds of research, so that is why the low fees is included here, right? Because as if you will compare it with the active fund, so they are doing lot of researches, so that is why active buy and selling was there. But if we go with the passive fund, so that is not included here, so that is why they charge you lower fees. Okay, now it is a long-term growth. Okay, long-term means you have to just invest for the one time. Okay, then you just have to go with the Nifty. Okay, if it is going good, so from a long time, you can see right now our market is in bullish direction from a long from the last 3-4 years. So that is how you have to invest for the long-term growth here. Okay, so that was the fourth point in active mutual funds, right? Now let's check about the comparing the fees and expenses. So as I have already told you here, if you will see in the active funds also, it includes management fees. Okay, so first the fees is included, that is to manage your mutual funds. Then the trading cost is also there. Okay, like if they are actively buying and selling, so there must be some trading cost. Okay, so that is also there, and the other expenses associating with it. So there are so many charges that has been included. For example, the exit load is there. Okay, then other charges also. Okay, so that is also included in the active funds fees, right, that you have to pay if you are investing in that. Now in the passive funds, generally lower due to the simple index tracking. Okay, they are not doing any research, they are not doing active buy and selling, just going with the trend, just going with the nifty, bank nifty, okay, or large cap. Okay, so that is why they are charging you lower fees in the passive funds. Okay, right, now let's go ahead. So then if we compare the performance and risk, so if we'll compare the performance and risk, so right now what the active mutual funds are doing, they are going for the active, the aggressive stocks, you can say. Okay, and in passive they are going with the nifty, bank nifty, right, where the general market is moving. Okay, so in that type, if you will see the active, so there is potential high returns. Why potential high returns? It is not means that it will give you a potential high returns, but after all this research, if we are including our money in a particular stock, that is we have chosen from a lot of research, so there are chances that it will give me a more returns as comparison to nifty. Okay, right, so there are a potential for high returns, right. Now but the high returns comes with the high risk also, right, because if you have taken entry at the wrong time, if your fund manager invested in the active mutual fund at the wrong time, so it may cost you a lot, a loss, right. Again in the passive fund we can see you that tracks market performance, right. So the way the market is moving, that is how your mutual fund will also move, and it includes lower risk, right, because you are investing in the stocks that are included in the nifty 50. Okay, so generally you will not be facing that much loss, right. Okay, moving ahead. Okay, so then the diversification strategies. So I have already told you in the diversification, if we'll go with the active diversification, so that is not that much diversified. Why? Because they just focus on a particular, not even I can say sector, but they focus on a particular stock that is moving, that is performing good, or that can, that is showing the signals that it can outperform the market. Okay, but if we talk about the passive, so it shows you a very good diversification. Why? Because of so many 50 stocks here. Okay, index stocks here. So and these stocks are selected from various sectors, you can say, right. So we generally see a diversification of the mutual fund or the performance also, right. So this was about the diversification. Now choosing the right fund for your investment goals. So what would you choose about after all this discussion? You have to go with the active funds or you have to go with the passive funds, right. So the general idea is that it depends on your risk tolerance. Okay, if you are able to tolerate a greater risk, then you can go with the active ones. Okay, if you are not into that much risk, you don't want to risk your capital, your investment, then you can choose your active funds, right. But the risk comes with good profit, so there is a potential for growth also if you will take the high risk. And if you are not ready to take the high risk, then you have to settle with the passive that will not provide you that much potential growth in your funds, right. So that is one of the thing that you have to keep in your mind while you are doing investment in this. Okay, then the second thing is the investment horizon, right. If you want to invest for a long time, then you can go with this. Okay, because it is giving you with the passive ones, because it is giving you potential low growth. But if you will invest it for the longer time of period, so there are chances that it can be a potential profitable for you, right. Similarly, if you will go with the passive ones for the active ones, so active ones they buy the stocks that will show you a profit, that will show you a growth at a shorter time frame, but they will exit as soon as possible. Okay, because there may be chances that that stock will fall after some time. Okay, so there is an aggressive buy and selling is going on, right. So the active funds, they are usually for the shorter time span, right. Now the financial goals also. So the financial goals, if you want a good profit at a shorter time frame, so then you can go with the active ones. Okay, and if you are planning for a future, for example, you are planning after 10 or 15 years, you are planning for your child's marriage. Okay, if you are planning for anything after 10 to 15 years, then you can go with the passive ones. But if your financial goals are very short. For example, you are planning to buy a car at the end of this year. So then you can go with the aggressive one, that the active one that you can go, because that will provide you more potential growth, right? So these are the three factors that you can keep in your mind while you are choosing, like if I have to invest in active or while I have to invest in passive funds. Okay, so this is the difference between active and passive funds. So I hope this video is useful for you. You get to know more about like in which I have to invest, in which fund manager, like which type of fund manager you have to choose, one who is doing the active one or the one who is going with the passive ones, right? So that is how they will charge you also. Okay, so I hope guys आपको वीडियो पसंद आया होगा, ठीक है? You can also like and comment in the video. If you are new to the channel, you can subscribe it. Thank you so much. This is your trainer Ankit Singh Rawat. Have a good day.